Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How's it going today? Hope you're having a good day out there. This is our quick FinTips series where we just go through quick things, teach you something new, go over something interesting, and get out of the way so you can keep your dough straight. You can sort on our channel, our YouTube channel, by channel or playlist, FinTips. So hope you'll check it out. If you enjoy, hit the subscribe button or check us out at Jazz Wealth Managers. I do appreciate it. All right, here today what we're going to talk about is this bull market. Is the bull market over? You have an opinion. I have an opinion. Everybody's got an opinion. But at the end of the day, we actually need some data to go on, right? It's kind of like watching SportsCenter and they're just talking about who's going to win Super Bowl or whatever, or some big game. It's just opinions. And then occasionally somebody comes along and says, yeah, but check it out. All through history, when this happens, blah, blah, blah. And I know there's a lot of variables there, but at least there's something to go on. I really don't like when people just have a straight opinion and they don't base it on anything. So what I'd like to do is dive into a few things here for you today and see if I can help clear up the air a little bit. Here's where we're at. For 2020, you've got basically every analyst predicting they're saying between a mid to high single-digit return is what's expected for 2020. They always say that, by the way, and I did a class on this to explain it. But at the end of the day, a mid to high single-digit return almost never happens in the stock market. In fact, to prove it to you, we did a class with our customers. I'll share a slide here with you. If you're one of our customers, you can go in the dojo for the whole class here. But what we did is we looked through the entire history of the S&P 500 to say, well, how often do we return mid to high single digits? It's only 6.7% of the time. It almost never, ever happens, but that is what analysts have currently predicted. So feel free to check that class out if you're one of our customers. Look, you've got Morgan Stanley saying that the average return over the next 10 years is going to be 4.9%. They're not looking too optimistic. You got UBS saying between 4 and 6% is going to be the average return over the next 10 years. You got Bank of America saying less than 6% will be the average return. Everyone thinks that this market has come too far too fast and that we're done. But let's take a look. Let's go a little bit further here. They may be right? But at the end of the day, I want to use some data here. We're going to expand on a study done by BMO. Brian Bolesky did a study. I like it. He's using stats. We don't necessarily know if they're going to play out in the future, but at least he's using something here. So let me dive in here and share this with you. What we did, he took the last two secular bull markets, and he plotted them on a chart, basically, to show that they did the exact same thing. The 1948 to 68, 20-year bull market there, that's on there for you. And 1982 to 2000, the last one that we have available to us, he plotted them on a chart and noticed something, a couple things interesting, and I'm going to expand on them here today. What we found is that, or what he found initially, was that the first part of this secular bull market, 11.7 years is the average between the two there. Average is 14.3%. All right, no problem. Then there's a period of time where next to nothing happens. There's a period of just over 2 years where the average performance is, it's lower. It's under 4%, right? That's where we're at right now. If you take 11.7 of the last years here, we're now in this window right here is what he's saying is that, look, it's okay if we have underperforming markets, but let's look past that window and see what happens. The key here is that after this performance here, which was next to nothing, the best part of the returns of those bull markets came following the 2 years of quiet. So you had 11 years of a market running up and everybody goes, oh, okay, that's it. That's enough. The market's going to pull back. The world's going to end and everything. But in fact, it averaged still a positive return of about 4% on average for those 2 years. Then you go 5 years out from that. That's where the best performance actually starts to kick in. How cool is that? That's kind of interesting. I thought it was kind of interesting anyway. So if you were to plot the S&P 500 now, right over the top of this, it's almost identical. Almost identical. In fact, here is the S&P 500. If you look back over the last 11.7 years, if we just assume this was the very moment that this happened, average return 13.17%. What did O'Brien say at BMO? 14.3, right? That's what happened the last two secular bull markets. We're at 13.17. That's pretty close. I think that's pretty close. And you want to know something else? If by chance you like this, now it's only 2 data points. I get it. We're only looking at 2 freaking data points here. I could understand if you said, it's not enough. I'm going to need more points. Okay, fine. But if you look at where we're at right now, S&P 500, 13.17%. Now, let's take a step backwards here. We've got 2 different bull markets, 1948 to 68. That's 20 years. Did you know that there were 3 recessions during that time as well? So here is the actual performance of that time period. Your 11.7 years, your 2 years of quiet during a recession, then bam, there's your performance going after that. There were the gray shaded areas are the recessions there. So from 1948 to 1968, 3 recessions inside of a monster longer term bull market there. So I just thought that was really cool. There was 2 recessions, 1982 to 2000, by the way. So the fact that we have recessions along the way doesn't necessarily mean the end of the world. Now, 2008, yeah, that's a different story, right? But we haven't yet seen what's coming out of this yet, so we don't know how to really kind of add that to the data. Unfortunately, it's so many years that we're working with. The point being, yeah, there could be a period of a couple years here where returns are a little bit hard to come by, which means you, number one, have to make sure you're being as efficient as possible, but you're also taking the least amount of risk for the highest possible return. All of this nonsense that we used to play where you just buy the big growth stocks, buy all the big growth funds and everything, sit back and hold tight, that may actually turn out to be a worse decision over the next 2 years because that's going to be more volatile. So while everybody else is being more efficient, just generating little returns if that's what happens, those large cap funds and those big aggressive stock funds, they're going to be a lot more volatile. They may actually finish the year negative just out of pure volatility, not that you're making a bad decision. But you definitely want to look at volatility and you want to look at being as efficient as possible in your 401k, in your IRA, all of those accounts there. I don't do these things to scare you. I do these things to teach you here. So hopefully you learned a little something from that. If you're currently working with an advisor who's never shared anything like this with you before, I hope you'll keep us in mind at Jazz Wealth. This kind of stuff we like to focus on. I will wish you a great rest of your day and hit the thumbs up button and let me know what you think about it, good or bad. Just let me know what you think. I can't answer to the comments there, but I can see them. I can't respond. But anyways, let me know what you think. If you'd like to see more of this type of study detail and things like that, happy to dig into it, but let me know. Enjoy the rest of your day. We'll see you later on The Closing Beat, 5 o'clock, live on our YouTube channel. Adios.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.